So, yeah, just like to welcome you all to the first of our Cultivate 2 Ask the Accountant series with Michael Harvey of MDH Accounting from Launceston. Michael's been very generous with his support of Cultivate over the last year, and we're looking forward today to having a great introduction to the wonderful world of profit and loss accounting. So with that, I will hand over to Michael.
Thanks, Darren. Thanks for letting me come in and share. I'll just try and share my screen. And hopefully everyone can see that.
Yeah, that's looking good.
Full screen mode. All right, so today we're looking at the profit and loss side of the financial statements or financial report for a business. And so today, just in terms of a rough agenda, as Darren said, I'll just chat for about 15 or 20 minutes and then take questions. So we'll just go through what is a profit and loss statement, look at some of the terminology that you might have heard around the traps. I'll introduce you to some accounting concepts of cash versus accrual as your business grows, or in business terms, it's sort of one that pops up quite frequently. Last time we ran the series, there was a few questions around depreciation, so I'll just cover that as an aspect of profit and loss as well. Then I'll just look at what are the key numbers when you look at a profit and loss statement. What are you looking for, and what does it tell you? Also cover what to watch for, so I suppose some tricks and traps. So I probably had on the mind, you know, if you looked at, say, another business, what some of the, I suppose, ways of hiding things or things that may not jump off the page to start with. And then we'll just go through a short worked example at the end. So what is it? Profit and loss. It's a financial report at the end of the day. It's all about the numbers, and it shows certain aspects of the business. It's a snapshot. It covers a period of time. So typically it might be a month or a quarter or a year. So compare that. Later on we'll do the balance sheet side of it in another session. The balance sheet sort of like is a window at a point in time, whereas the profit and loss is a description more of what activity has happened over that set, saying that's whatever the defined period is. And what does it cover? So it covers your sales. So other terms that may be used, income or turnover, all synonymous. Then you have cost of sales, COGS or cost of goods sold, COS or cost of sales, or your purchases, stock, things like that, all go into your cost of sales to derive your gross profit. So your gross profit sales as to cost of sales, and your gross profit's your margin, or if you want, your markup, another way of looking at it. Then you've got a bundle of expenses, so operating expenses. We'll go through those, what some of the examples are in that space. So these are if you overheads, although some of these are operating expenses, what it costs us to run the business. Then you end up with your net profit. Another term is operating profit, depending on the structure or the legal entity you're trading with in your business. And it could be a net profit before tax, or if it's a company, then you would have income tax taken into account. All these figures in a profit and loss are also ex GST. So if you are registered for GST, then that GST portion of the sales or your purchases gets tied away on your VAT statement, and it's all ex GST. And if you're not registered for GST, then obviously it's just the figures as they appear. Some terminology. So just to, I suppose, profit and loss is sort of the main term that gets used. Accountants and academics get excited sometimes, so they come out with other accounting standards, and at various times they call it an income statement or an income and expenditure statement. All the same things as a profit and loss statement of your revenue less your costs, basically. Another term you may see sometimes, a trading statement. to me, a trading statement is really a subset of your profit and loss. So a trading statement tends to pick up to your gross profit section of your profit and loss, so your sales less your cost of sales. Another term has been involved with sometimes with not-for-profit organisations is a statement of receipts and payments. That's different. That's more about a sort of a hybrid that you typically see in smaller organisations or not-for-profits side of things. That's conceptually more like a cash flow summary. So I'll just introduce you to, I suppose, a common aspect of when you're looking at, so if you run like any of your MYBs, or any sort of accounting packages, even your GST registration, what a common attribute is, are you running cash or accruals? So it's a sort of a common theme that runs through all sort of set of financial statements. So cash in, or look at cash first. So cash in is when you actually receive it into your bank. So if you're taking it through an FPOS facility or people paying by EFT, things like that, that's cash hitting your bank account. And then cash out is when you pay your bills, when your cash comes out of your bank account. So if you're on a direct debit for rent or pay your wages for your staff and things like that, it's when it comes out. Accrual as a sort of an alternative method. So on income, so an accrual date. So if I sell a good today, but I allow credit terms to my customer for 7, 14 days or whatever, then I'll recognise that income when I've shipped the goods. So the goods come out of my warehouse today, and I'll say, yep, I recognise that sale as on the 9th of December. So on an accrual basis, I'll book that as a sale. Similarly, today I might also receive delivery of some goods, and so I've got the invoice from PFD or whatever for the goods that I've been received, and so I would put down the 9th of December as the date that I received the goods, and I'm liable for that because I've now got an obligation to pay. So I recognise that as an expense on my books as at today's date. So a little bit finicky. It really only gets down to like the 9th of December. It's not a magic date, but if you're running a monthly report and it's the 31st of December is the magic date, then if you receive something on the 2nd of January, then obviously that's going to fall in a different month. So you get some timing differences when you prepare your financial reports. So what does it look like in practice, difference between cash versus accrual? So there's some major differences. So under accrual method, you have what you call a depreciation expense, and I'll unpack that a bit more down the track. And on a cash basis, you've purchased the asset. So if you bought, say, a new computer today, and you pay for it straight away, then you purchased an asset for the company, and that ordinarily wouldn't sit on your profit and loss statement, sit on your balance sheet to recognise that computer is going to last, more than 12 months is the rule of thumb. So I'll come back to that, so depreciation versus assets in a minute. So if you're offering credit to people, so you're going to have a thing called debtors or accounts receivable is an older term, it's the same thing. So this is when you offer credit to your customers. So you've delivered the goods, they've got an obligation to pay you, but you're giving them credit terms. So you haven't received the cash. So then you're going to you're going to have a debtors balance, aged receivables on your books. On the reverse side, say creditors, or another term, accounts payable. So you receive the invoice from PFD or whatever, and you have an obligation to pay, but you haven't made that payment. So under accruals, you'll set it on your books and to say, yeah, I know what I need to pay. Another major difference is if you've got borrowing, such as you've got a piece of equipment and you've borrowed money from a finance company, then in cash terms, you've got an obligation to pay the principal and interest back. So in cash terms, you've got a cash outflow, but in profit and loss terms, we only recognise the interest component because the principal goes back to pay off a debt that you've picked up when you took out that loan. So there's some sort of, I suppose, some major differences when you look at cash versus accrual. Just as a business grows, typically you'll start in very much a cash position because that's nice and simple. You just get your bank transactions and it's the plus and minus of that. As your business grows, you really need to get a better handle on what people owe you, so if you're offering credit, and likewise if you're racking up creditors or bills to pay. By putting it through an accrual method, then you've got a better handle on where the business is at, because the cash at bank figure may be over or underinflated depending on what credit you've given or been given from your suppliers. So just to step into sort of a bit of a depreciation example. So if you purchased a piece of machinery for $10,000, so you've got cash outflow in terms of paying for that. And in accounting terms, you go, that piece of machinery is going to last me 5 years. So in a profit and loss term, you're going to have an expense of $2,000 every year for the next 5 years to effectively amortise or write off that cost over its what's useful life. So that's the sort of accounting theory. And then we have tax law, and one of the government really loves to incentivise businesses to make investment in capital investment, and so they have a range of incentive programs to give you a greater tax deduction than what the useful life under accounting terms looks like. So you buy the piece of machinery, and the tax deduction at the moment, post the recent budget, you can claim a tax deduction for that piece of machinery and get 100% of that as an expense straight away. So often I see profit and loss statements which will be driven by the tax consequences of some of these items, not necessarily driven from what is reality. So it's just, I suppose, a little asterisk to have that you won't necessarily see $2,000 depreciation expense for the next 5 years, because a lot of small businesses produce their financials to do a tax return, and therefore they'll claim the $10,000 as a depreciation expense in the first year. So that's hopefully just try to explain a little bit what depreciation theory is and the practicalities of when you say get a tax return financial statement that prepared by your accountant for their tax purposes. You'll probably see a higher depreciation expense because of the tax incentives being available. So you've got a profit and loss statement. I'll go through an example in a minute, but what are the key numbers? Sales is obviously a key number. So what's the turnover for the business? Gives you a sense of growth. So you typically would look at sales figures over a number of periods. That could be month on month, could be year on year, could be quarter to quarter, or if you've got more seasonality, you might compare this year to last year. So you go, quarter one, what are we in now? Quarter two for 2020, compare that to quarter two 2019 for the 3 months ended 31st of December. So there's the sort of things, and you're looking for growth or a story behind that particular number. Another number that I think is absolutely key for businesses is gross profit. So it's your sales less your cost of sales. So typically in your cost of sales, you can put in there your purchases, cost of production, any freight out if you're delivering that to a customer, and then you're adding that to your invoice, or you need to take that into account when you set your pricing. So the way I look at the gross profit is every time you turn over a particular item, what is the gross profit both in dollar terms and in percentage terms? In percentage terms, you're looking at percentage of your profit compared to what you sold it for. So it's just a really, really key number. Depending on the nature of the business, another one that can really, just go back to gross profit. That's a really great percentage to benchmark both amongst your peers or industries, just to make sure that you are attaining that. And I just see some businesses will chase sales growth and sacrifice gross profit at their detriment. So it's getting that right mix. And typically in your distribution channels, if you're chasing, say, volume through, say, a Coles and Woolworths, something like that, you're going to get sort of growth, but at a lower gross profit typically because of the rebates and other adjustments Coles and Woolworths might do. On your operating expenses, you get salaries and wages as a business grows. So if you're starting to employ people and your role in the business might be changing, that's where costs can quickly come out of control. and where typically you'll benchmark that as a percentage of sales to say, okay, I don't want to spend any more than 30% of my sales on salary and wages, something like that, as a sort of a discipline within the business. Some businesses I see will also benchmark that against the gross profit, depending on the nature of the business, but typically you'll benchmark it at least back to sales and manage that accordingly. Bear in mind, salaries and wages also tracked on costs. So typically you're going to have 9.5% superannuation, and then you might have workers' comp, payroll tax, depending on the size of the business. So just bearing that in mind as well, that your actual cost might be slightly higher once you add in your on costs. Another one, depending on the nature of your business, again, is just looking at your occupancy costs, such as your rent and outgoings and other costs of having the shed or the shop front and stuff like that, and looking at that percentage of sales. And there's some pretty good benchmark data out there now, both the percentage of sales or some pure retail stores looking at per square metre type of ratios to make sure that their costs stay within manageable proportions there. Then we're looking at net profit. So you're looking at, after you've done all this activity, you've paid your or accrued all your right expenses, what is your net profit? How many cents in the dollar at the end of the day are you achieving? And so typically you'll take that back to your sales, and you're looking at 10 to 20%, typically, hopefully higher, but 10 to 20 is sort of a range you're going to have. You're looking at, is that an adequate return for all the effort you're putting in? If you're only getting 8 cents in the dollar for every dollar you're turning over, you go, it's a lot of effort for little return. But you might be on a growth trajectory, and there's sort of a rationale behind that. They're just some of the things you look at when you're looking at a profit and loss statement. Another term which I'll just introduce today, but we'll cover that down the track when we look at sort of business valuations, is a term called EBITDA you may come across, which is technically earning before interest, taxes, depreciation, allowances. As I said, we'll cover that another day, but that's driven from the profit and loss statement where you do certain add backs to come up with what is the underlying cash flow for a business. Some of the things to watch for, they've sort of seen, if you want the tricks of the trade, I didn't mean it in a bad way, but just if you're looking at other businesses or things to check on, you're looking to see what's hidden in sales sometimes. So in the last 12 months, there's a range of government incentives, programs, JobKeeper, cash flow boost all come out. I'm looking for any non-recurring income that might have been classified as sales in the books if someone brings me a profit and loss statement. So I want to strip that out to say that was just a one-off event. Yes, let's have a story about how your sales suffered over the COVID period, but let's identify these as sort of non-recurring income that's not sales to a customer. Another trap is accruals, where last year I was involved as sort of I suppose an expert witness for a guy who bought a business, and it was sort of a mishmash of accruals and cash in the way that the figures were presented. So on the one hand, sales were done on an accrual basis, but the purchases were done on a cash basis. So it sort of underrepresented the profitability, or overrepresented the profit, but underrepresented the cost of sales in what was presented. So that's the thing, just to make sure that makes sense when you're looking at a profit and loss statement. And there's a sort of an accounting principle. There's a sort of a matching principle, so that if you're buying a good, you're doing something with it, and you're selling it, that you're accounting for it on a similar methodology, and that's sort of disclosed. The other one is stock on hand. Going back to sort of one of my earlier examples, say if you received the goods on the 2nd of January, but you didn't do a stock count to the 5th of January for the December, then you can get some timing differences. What is your true stock on hand figure if you're sort of haven't got I suppose a more sophisticated inventory system of tracking different products and items, especially if you're making your own product. And then I got another client the other day, just a sole trader startup, and as she's grown her business, she's going, my profit and loss doesn't give me the right figure. And it's right, because she might take up a bulk discount to buy some items that she might not use for 3 months, but she wants to get the discount. And in the past, we've sort of said, oh, let's ignore stock on hand movement on a monthly basis because it's only a micro business. But now it's starting to distort the figures. So now we're going to come up with a rough estimate of stock on hand at the end of each month, just so we can adjust that to say, well, your purchases might have been 15,000, but 5,000 of that's really for future months. So we'll treat that as sitting on stock on hand. For those of you who sort of follow sort of the financial media, there's a publicly listed company, Freedom Foods, out of New South Wales. So they've just restated their financials for the last 3 years, and it's just a classic example of I suppose, the tricks of the trade where stock on hand was booked on the balance sheet, which obviously stated the profit and saying there was $10 million of stock on hand, and when they came to look at it, when then some new owners started to have a look at it, it was old stock that really had to be scrapped and written off. Stock wasn't there, so that's just another little trap to say, what is the stock on hand? How is it valued, both in terms of the quantity? Another little trick, sometimes you see some people will value their stock at what they sell it for, when really it should be what you bought it for, what your cost of production is. And you don't recognise that profit on your sale until you actually sell the goods. But I've seen the fish farm industry was a classic where the accounting standard for a period actually allowed you to book your profit as the fish were growing. So that was sort of another little sleight of hand if you want just to watch in that example. So I'll just try and flick up a worked example. A bit small, hopefully people can read it. So this is a profit and loss statement for the period 1 July 2019 to 30th of June 2020. So in this example, you're looking at this year to last year. So this year's 12 months to 30th of June 2020 and compare it to last year. So first thing to note, once again, it covers a period of time. And with modern accounting systems, you can just go in and change the date ranges, what you want to compare. But it's a period of time, what you're looking at, what activities happened in that business. So you're looking at income, you've got sales line, 572,000. Then in this example, your cost of sales. So what you got is your opening stock figure, how much your purchases were for the period. We included in there some freight and delivery that on the outgoing of your goods. You've got some packaging that you're adding to the production, and then your closing stock figure. So you got total cost of sales and come up with the gross profit and 227,000. I've shown on there where an example where you're pulling out other income that's not really related to the gross profit. So in this one is these guys are entitled to a fuel tax refund, a diesel fuel rebate. So we're just showing that separate. So it still forms part of your profit and loss, but it's not part of your sales figure. So just an example there. So operating expenses, a couple of ones to note there. You got bad debts written off. So that's over a period of time. You just got to, this is on an accrual basis. So you're going to write off your debts that people are going to pay, make that assessment. You got a depreciation expense in there. So that's as I said, that may be driven by tax, may be driven by accounting. So it's just a question to clarify when you're looking at figures like this. You're looking at interest expense. So once again, if you've got a loan, you're not going to see the full loan repayments. So why I point the depreciation and interest out, they can distort. So this business is really profitable, but behind the scenes it might be really cash poor because it's got high loan commitments, or debtors are blowing out, or it's spent a lot of money on capex, capital expenditure, that's not been written off on the profit and loss. So just I suppose some questions to ask when you're looking at a profit and loss statement. And then you've got wages and salaries down the bottom. So operating expenses, 167,000, net profit before tax of 62,000. And then just pretty simple examples of the four key ratios I look at for this business. So you're looking at gross profit. So gross profit in dollar terms as a percentage of sales. You're looking at net profit. So this one made 62,000 on 572,000, so 11%. It's okay. It was down on last year. COVID, yeah, okay, let's reconcile that. Wages and salaries are quite low in this business at 13 to 15%. So a practical issue is then owner's wages for a lot of businesses when you come to look at profit and loss. Typically at the moment, that wages and salaries in this example is people you're paying outside of yourself. And then you're looking at rent and outgoings as a percentage, so quite a low percentage at 8%, 9%, the one you want to track. So it's just a sort of a real life example of what a profit and loss statement looks like. So I'll stop my sharing and open it for questions.